I'm Paul. I'm co-founder and CEO of Morpho. We do on-chain lending and borrowing stack, so allow people to earn yield on one end on their assets and get financing on the other end. We work with pretty much every single exchange to power their lending and borrowing services, as well as fintechs. And in the Morpho stack, you need people to manage assets and underwrite the credit or the loans. And those operate under vaults that can be run by multiple entities, from the most crypto native entities to the most institutional. So yeah, that's about it.
Christine?
Hello, Christine, partner at Apollo, $900 billion asset manager focused in private markets.
Right.
And that's the modest introduction.
I say one, she says that.
My name is Michiel, one of the co-founders of Tioga and also co-organizers of this event. Look, I want to kick this off with a discussion that we had backstage. I want to take it from stage. We had a discussion on why are institutions finally coming. Paul, you had your reasons. Kevin, you disagreed already. Maybe we can start there. And then what we didn't hear was Christine's take, who's actually the best person to talk about that.
All right, Paul, kick us off.
Yeah, so I guess my initial belief that was that institutions were going to come in for the tech, like blockchain, super efficient, gonna make all the backlog processes and post-trade operations super efficient. Turns out in my experience, what really brought the institutions in was the business reasons, aka AUM. As soon as we started to have a few billions of dollars of stablecoins that needed, an asset manager that needed yield, well, this is where we started getting interest from the large, traditional asset managers, large institutions, right? Started, for example, with the Sky, RFP looking for, RWAs to underwrite. And to me, that was the first time where I saw actually institutions compete for a crypto product, which is not something you see usually, right? And so really it's interesting because we really thought that blockchain, at least in my perspective, was going to replace the tech. And TradFi was going to be the business side, and it actually was the opposite. It's in the world of RWAs, TradFi is still the tech, right? The RWA is still, oftentimes an off-chain fund, right? That is brought on-chain, and only the shares are being tokenized to serve and distribute. I think that's the arc one, right? But the reason why institutions will stay in the long term is because the tech, and more specifically, the network effects are stronger when you're on-chain. The blockchain allows us to have this open garden in which you can aggregate a bunch of different lenders, a bunch of different borrowers, a bunch of different traders coming from all over the world. If you take Morpho, for example, you have borrowers coming from the Coinbase platform. But those borrowers are funded by Bitpanda, by Binance, by Kraken, by Gemini, et cetera. And they all aggregate in the single same open lending and borrowing book, making it deeper liquidity, better pricing, et cetera. And this is a pretty unique feature that you could also, get a similar state in TradFi. Obviously, you also have very strong market structures, but the nature of blockchain makes it much more open and permissionless, and as a result, much more open for liquidity to come in. And I think as we see the snowball effects of having more liquidity, begging more liquidity, and the openness fostering everything, I think this is just going to turn into an unstoppable snowball that will take over the entirety of traditional financial markets.
So they came for the on-chain stablecoins. Kevin, you disagree?
Yeah, I mean, I disagree on. I agree on where the end state is, right? Is that eventually you have something that is a lot more efficient. There's better tech, something that is more integrated, and also something that provides you a much better distribution. But I don't think that they came for distribution because currently there just isn't one, quite frankly. And if you look at, there are many amazing traditional asset managers. Some of them are on stage tokenizing very interesting products, but they're still somewhat stuck between, they did the 0 to 1, but then who can actually access those products today? On the one end, you take a traditional asset, you tokenize it. What that means is that you're cutting yourself off to some extent from your existing investor base because they're not used to interact with tokens. So you're somewhat hampering that part of the distribution. And then you're going on a new distribution rails that are fully digital, where many of the actors or the existing participants actually cannot access what you just tokenized, either because they don't know the product or simply because they don't want to do a full KYC or they cannot directly access security. So you're also not benefiting from this additional distribution capabilities that you will have down the line. So I do think that the reason why they're going to stay is, you're right, is because the distribution is potentially much bigger. But I would just be a bit careful now saying that they came for the distribution, because that implies that distribution is not a problem that we need to solve, where I think it's actually the biggest problem and the main reason why this is not growing at real scale yet. So
Yeah, I think that's right, and I think it would be just like it sparked the interest of some business units,
Yeah.
whereas before it was more the technical team or like that was piloting stuff to do like PR announcements, whereas now as crypto projects we can address business units that really can drive stuff, right? But I guess-
Okay, so I'm just
Christine,
going to
help me
disagree with
answer
you
it.
both. I came for the future. We're here for the future. Neither the tech nor the distribution. We're here for the future. So at Apollo, we believe in a world of change. And I feel very fortunate to work for leadership that believes that the world is in constant change, and the hows and the whys that Apollo has been successful in the past 3.5 decades is absolutely not going to be how we're successful in the next few decades, right? Especially technology, is just, the tip of the spear. So, I mean, in terms of like why we're here, like definitely positioned to the future, like just seeing that there could be, all different types of disruption, either technological or business model, distribution disruption. The world is changing, so want to be at the front edge to actually learn about all of that change. How was that? How was that? I'm trying to make it spicy. In reality, I agree with you both. In reality, financial institutions came for the technology about a decade ago, and there was all this promise for operational efficiency. But in reality, operational efficiency is hard to actually capture and doesn't really pay the bills. And so you do need the commercial use cases to actually bring a lot of that technology to reality. Like people get a lot more excited about building new businesses and new experiences and expanding business than constricting their business. And so I think it's been both. So the education cycle in the early part of the decade of where we have been in enterprise blockchain and now digital and stablecoins is the technology. Now it's the commercial that is like pushing everybody out of their prototypes and pilots into reality, where we are finally at the inflection point to build real businesses that we hope will scale that are currently not at scale. And then, as I mentioned, hopefully, kind of being at the front edge and not being disrupted by all of the change that will come.
Okay, so what I take away from this is that Apollo is here for the future, but we've been building a future for 10 years. Like, why now? Like, why is this moment?
Well, I mean, we've
Special.
been here for the past 10 years. I've been here for the past 10 years. So it's been like now, like every year.
But it feels like a tipping point. You announced this partnership with Morpho. You're gonna buy up to 9%, I believe, of the Morpho tokens. So that wasn't there in the previous cycle. So what has changed?
Yeah, I mean, exactly what I said, which is I think two things. I think that what's interesting is that most traditional financial institutions underwrite the technology with the idea of the entire rest of the world will get on chain. But that has not happened yet. However, the world that is currently on chain, all of us, has grown big enough to be, meaningful enough to actually build at least a kernel of a real business where they weren't there before, to Paul's point. And so, I think that we're kind of at this inflection point where, if like with enough users, enough capital, enough like activity, enough proven technology and resilience on chain, that we can actually start building real businesses. And like actually like we as the ecosystem being like sort of the vanguard users, like the pioneers, that we can sort of shape the products and the businesses that can be viable, and that and we obviously have a large tolerance for jankiness and like weird weird stuff and like bad user experiences that need to be improved. But like we are a patient vanguard pioneering crowd that can sort of shape and refine these business products and businesses that will eventually become good enough to attract everybody else into the on-chain economy, which then will help us scale. And I think that will happen fast. Like I think it's like sort of like slow burn, getting to a certain point where it's like finally like, I mean, in all cases, like unless something is like 10x better than what you currently have, there's just too much inertia to like want to change your behavior, trying to change your system, trying to change so I'd say that the technology is promising, but we have not yet gotten to like 10x better than like what happens off chain. I think obviously there's a lot of potential and we can see the pathway. And, as someone said, earlier in one of the panels today, like now time is compressed, especially with AI technology and like, kind of how software develops. Like time is compressed. Things that would have taken years now take months. So like now we're even accelerating much quicker than we think. So we hope we're sort of stepping into a point of time where, we can finally get to building real businesses with everybody who's on chain today, and then accelerate with broader adoption shortly thereafter.
Yeah.
I think
But
you mentioned what has changed. I think also like the theme of tokenized securities. There was already all the rage in consensus 2018. Same topics, same thing. But like back then there was nothing. Like how are you transacting digital value? How are you custodying it? Where can it actually be used as collateral? How deep can you get? How deep liquidity can you actually get? Like there was absolutely nothing. So you just had 8 years to actually build the underlying infrastructure and rails that you need so that we get to a point where finally things can move somewhat efficiently. Still a far cry from being 10x better, clearly. But it's having this basic level of infra that allowed it to become big enough to actually attract interest from large institutions, which is what eventually will really kickstart kind of the flywheel effect to get it at scale. But I mean, there's a lot of things that have been built over the last 8 years that allowed us to get to where we are now.
Yeah.
I'm going to give myself some credit, though. I feel like some of the strategy decks that I wrote like 10 years ago still relevant, still apply. Just like taking some time to like actually get live and like, the implementation slightly different because, like the things that DeFi has brought were sort of unexpected and new. Some of the early things that we tokenized, like tokenizing fixed income, like, we were building out like global holiday calendars, like, trying to model that out on like in smart contracts of Ethereum. And then DeFi came by and like just blew out the idea that you even were counting time in calendar days. Like you actually just call it like counting in block time, and that there would be no holidays. So like stuff like that, like I did not expect. But like the general contours of like strategy like still persist actually, like 10 years later.
I think to me, the why now is really like, so on the business side and on the tech side, there are two very specific points in time. For the business side is really seeing all the distributors over the last year starting to move on chain. Like if you take all the crypto exchanges more than a year ago, they were all building on top of backends, like literally centralized backends, right? And ever since Coinbase like announced they were like moving all their lending and borrowing activities on chain on Morpho, every single like fintech or exchange is thinking about this like DeFi mullet style integration where they think of the chain as their backends, right? And they think of the chain as a backend that will be shared with their competitor, where they will share liquidity with their competitor, they will share efficiency with their competitor. And I think there is the reality of today, which is like a few billions only, like coming from Coinbase and Morpho, and a few hundred millions from other exchanges in DeFi in general. But now, if you get into the board of every single fintech, they all have a roadmap to move everything on chain. Like not just like the crypto section of the app, which is about speculating on new tokens. It's about moving the entire financial stack of those distributors that had been owning distribution but not owning infrastructure. And for them, it's an opportunity to own both, right? And I think this momentum is noticed by the institutions, and they want to be serving those distributors as well, right? So that's like really the drive that is new and the why now on the business side. And now on the tech side, I think is just to Kevin's point, is like really infrastructure maturity. Like 2 years ago, it was still very expensive to transact on chain, right? And we cannot forget that, but there is like maturity at the infrastructure level, both in terms of latency, transaction per second, like gas fees, etc., but also at the application level. Like Morpho did not exist. Like the current deployment of Morpho, like Morpho Blue, did not exist 2 years ago, right? Today we have like $12 billion of deposits, but there was no such thing as like a modular lending stack that allows anyone to like manage assets on chain, right? So I think this was like the key ingredients that were needed to like start building this activation energy to start disrupting a little bit. But to Christine's point, like the activation energy we need to move the traditional financial markets on chain is still much bigger than what we have today.
Yeah.
But
Would you
and
say
to your
maybe
point, though,
just a quick point.
I want to give a shout out to Sky and the Sky allocators like Grove. Like I do think that their allocation of capital like has encouraged a lot of innovation and has encouraged a number of traditional financial institutions to come on chain. I mean, no one ever wants to tokenize anything and like have a token like sitting at zero. And so, I think that they have provided like really great support and like almost kind of like incubation, if you will, to allow like a place for traditional institutions to experiment with bringing their products on chain. Because keep in mind, like there's we have to like figure out how to get it on chain, but behind every, digital assets person at a TradFi is like them having to make the case internally, like why this investment of resources and time and effort and potential reputational risk is like even worth it. Like why not just conduct normal business? I mean, not everyone believes in a world of change the way that we do. So like, the case is harder for other places. Like, and so, got to give a shout out to the crypto native allocators out there that, are encouraging the real world asset tokenization work. Because it is helping to bring others, not just us, but others on chain.
On the infra side, I'm understanding that we're finalized, or is there anything missing to really get to the next level?
There's a bunch missing.
There's a lot.
So I think
What are the key?
so, speaking from the lending and borrowing perspective, the key, most important missing piece is fixed rate, right? It's like the thing that every single institution have been asking us. Like currently, for those who don't know, the way rates are determined in DeFi is through this sort of like interest rate curve that was super innovative. That was great in an environment where gas costs were high, where you had very few smart people on chain that were smart allocators of capital on chain, etc. This has changed. Gas price is low. We have super smart capital allocators in the lending space, capable of like literally every block bid on like new loans and everything. And so now is the time to introduce fixed rate and obligations trading to DeFi, the same way TradFi would do it, but this time on open rails, right? And this is something we've been working on Morpho for more than a year and a half now, and that we've disclosed. This is like our next big thing that we'll be releasing soon is about like fixed rate, fixed term markets, right? And with this, all this sort of like institutional grade like compliance guardrails, that package, that toolbox that comes with it, allowing anyone to like configure their loan and obligations the way they want, right? Having specific recipients or guarantees, not only just on the collateral, but broader set of criteria that allows to issue loans that go beyond crypto-backed loans, that can get into RWA-backed loans, stock-backed loans, or under-collateralized loans. I think from my perspective on the DeFi world, that was the biggest missing thing. And then on the infra side is definitely privacy, but I don't know much about this, so
Kevin, do you agree?
Yeah, I mean, so I agree. Yes, I think the part I would see as well that is maybe a bit more like far-fetched to some extent, but for me, what's missing is a way to have permission at scale. Like having something that is permission, but that can actually be distributed at the same scale as something that is permissionless would. Because, I mean, you have two things, right? Yes, you have the whole thing. How can we make your infrastructure like more efficient, less costly for large institutions? But what is also, I think, a very big part of the ethos of crypto in general is like, how can we make everybody own their own value and actually have something that goes directly to retail and individual investors, individual users? But I don't think that there's going to be a world where everything is going to be permissionless and just fuck it, let's go. That's not going to happen. So there is something missing. Like you can, of course, find short-term solution to have something that is somewhat in between, but that's always a little bit shaky. Whereas I do think that at some point you need to be able to have, I don't know, if it's scalable, ZK-based, KYC. I don't know exactly what that solution is going to be, but there needs to be something that allows to have some level of permissioning, doing it at scale, hopefully while maintaining a certain level of privacy, because that's what the ethos of crypto at the start was kind of like. If we're just rebuilding the exact same thing as in the past, where everything is centralized, everything is permissioned, and there's, it's permissioning counterparties is so costly that you can't do a lot of it. Well, what was the point, right? I mean, it's great to shave off, some cost, for the traditional market, but it's also nice to have something that actually changes how value is being exchanged. And so I think that for that piece, we're missing something here to do permissioning at scale. Yeah.
And how do you see those permissioned chains interacting with the permissionless chains like Morpho?
I mean, that's the whole question. Like, honestly, I don't have an answer. Otherwise, I'd be working on it. But maybe you.
I do have one. I think the infra should be permissionless and allow maximum connectivity. The application layer, meaning the DeFi protocols, should have necessary guardrails for the lenders and borrowers to be able to restrict in their intent who they want to interact with, right? And that should be at the application level. But it's important that it's not at the infra level, because the infra is the place where everybody meets, right? Mm-hmm. It's where every single fintech in the world, every single like distributor will bring to like this. The ideal state is like we have one single sharded chain, which is what Solana is trying to build, Optimism is trying to build, Ethereum is trying to build, right? And it's sufficiently decentralized such that it's a common ground where people can trade and exchange, right? And now in the DeFi protocol layer, you express who you want to trade with, whether that be everybody, whether that be a specific user that has a specific requirement, right? And then the matching layer of the DeFi primitive, whether that be options, trading, lending, etc., is in charge of matching your intent with everybody that is compatible with this intent, right? Meaning that if I have passed 10 different KYCs and I'm fine trading with people that have passed those 10 different KYCs, the matching layer should be sufficiently smart not to fragment liquidity into 10 different buckets, but actually be able to reaggregate and match me with whoever is compatible with a subset of my requirements, right? The superset of my requirements. But anyway, that's my thinking on how the problem should be solved, and also something we've been working on quite heavily.
Music to my ears, because basically, we love the magic of permissionless blockchain and DeFi, but at least for some of us, we live in a world of rules and laws and regulation and compliance. I think that the struggle is, how do we operate on these beautiful, frictionless, permissionless systems and preserve that magic, like that one click or just a couple click magic, but stay on the right side of the rules and stay compliant. And to both of your points, like that's missing. And nobody, I guess, wants to work on compliance. Maybe it sounds boring, but it's actually the most exciting thing and the most important thing if we really do want to drive mass adoption. Because the capital at scale, the distribution at scale will probably come in regulated packaging like me. And there's no way that we can operate entirely permissionlessly. And so, but if you let our teams destroy the experience by adding conventional, traditional compliance rules, regulations, paperwork, then that's going to be a bad outcome also. So it needs to be something new, something like what you described, or something that I hope all of you will build. Open call, please build it. It's really important. Anyone who's seen me this week, I am on a mission. I need someone to build frictionless experiences that are compliant for DeFi and blockchain.
I want to switch gears a little bit, something more spicy. I think.
This is not spicy enough for you? We are
even more spicy. It's going to be
spicy.
take it up a
super
notch.
spicy.
All right.
I would argue that the three of you are competing for the same dollars. You just entered the creation game as well, Kevin, with Keyrock. So let's say there's 10 billion in TVL. We can get a 10% return on that. It's 1 billion. We have the infra, which is Morpho. We have the curators, Apollo, Keyrock. We have the app layer. And then we have the end users. I would argue we're going to pass on 80% of the yield to the end users. So we're basically going to fight over the 20% that is remaining. Where is the value going to accrue between infra, curators, and the app layer?
I think there's multiple types of network effects and multiple types of expertise that justifies businesses at different parts of the stack, right? So I think what you laid out is correct. You have the distributors, the asset managers, and the marketplace, right? So the marketplace in our example is Morpho. Our job is to connect lenders with bars, lenders that did not know each other with bars that did not know each other. And as a result, you have deeper liquidity, better pricing, all the things we were discussing together, right? And so our role is connecting intents, right? And we create value by bringing together the two sides of the markets, right? And we take a fee out of this, like interest rate cuts, obligations, trading cut, like whatever you want. But obviously, interacting with the marketplace is hard, right? As an end user, on Morpho, we have 4,000 different markets, a wide range of collateral, oracles, etc. Some of them are meme coins as collateral. Some of them are scams. You have someone that needs to curate and be able to cherry pick what is actually good for the end user. And this is the asset manager layer, right? Which is both requires an expertise, but also has network effects, right? Because as you have this vault construct, you can accumulate liquidity and depositors, coming from different places, and that justifies a fee, that you create value by doing so. And then finally, you have the distribution layer, which you should think is like a Coinbase, a Robinhood, a Stripe, like whatever, that effectively consolidates this into a very nice user experience where you have access to a bunch of different services, a super app, which itself has its own network effects with a wide range of products, which also justifies a fee. I think everything in between, like coding, for example, is going to be compressed. Like I don't believe in SaaS in the Web3 world anymore. Like everything is going to be open. Like it's a race to the bottom. Like all the code will become open source and everything. So I think the three layers of value creation are the following. The distributor will take the lion's share because they're closer to the distributor, but they also only have their own distribution. Then the asset manager will manage assets will have a smaller share of the fees, but they will manage assets for a wider range of distributors. And then the network will probably have the lower stake rate, right? But they will connect the entire world. Like, Morpho is not interesting unless we connect the entirety of the money supply on one end with the entirety of people that want, financing on the other end, right? So technically, we'll map $200 trillion of credit. And if we take a small fee out of this, we'll be happy.
Yeah, it sounds like a good deal.
Kevin?
I mean, at the end, it's the same thing that what we've seen, for the last 8 years. So it's a game of volume versus margin. And yes, you're going to have more margin the closer you are to the end user, and then less the closer you are to the infrastructure. But then your volume is going to be much bigger. But I don't see it as competing for the same dollars because, I mean, okay, we create a vault. We couldn't do it without Morpho, right? The other way around, if there was no curators, then the infra is losing a lot of value. I mean, as any market, right? You have all those layers, they just pile up to make a nice cake. But I don't think it's not about competing for the same dollars. It's that you're going to have more margin on one end, more volume on the other, and at the end of the day, there's just so much efficiency to be gained that I think there'll be more than enough to share around.
Christine, one last take.
Yeah, I mean, I think the borrowers win because I think that they have access to a broader capital base, and therefore the borrowing cost is actually much more efficient. I mean, I think we see this in current markets today, like the DeFi market borrower rates versus the CeFi borrower rates are very more competitive on DeFi. Actually, it's shockingly competitive, where I've literally been I don't understand this. When I see things priced in CeFi, it's priced like this in DeFi. How does this make sense? So, borrowers clearly winning by accessing a broader pool of capital. And then the depositors are winning because they're, basically able to access diversified and higher yield that they would otherwise leaving their stablecoin idle, or leaving their stablecoin in platform. So yeah, we're all doing this for the cause. Nobody here getting paid, but hopefully the users and the depositors are going to win for the future.
Yeah, I think that's very fundamental to the blockchain technology in general, is that it fundamentally pushes the value to the edges of the network, right? Because of the nature of being very open, it makes it a bit drastically more competitive, right, for the infrastructure layer, for the capital operators, etc. And naturally, the tech rates for the ultimate consumer is going to be lower, right?
And ultimately, this is disruptive to our business.
It is,
right? So I mean, we've talked about this before. It's in the ultimate state, it's disruptive to what we do, which is lending, but why do we encourage it? Why do we participate in it? Why do we want to lead in it? Because we know it's going to change. If the technology is there and it's possible, then over some time it will happen. And now we know things will happen much faster than we think. So, rather, take the lead and identify that than be a taker of someone else's design.
Right. So disrupting your own business, that's why you're here.
Yeah, the game theory is that it will happen anyway, so you better lean in fast, and like Apollo is doing, because it's going to disrupt everybody else. And the last to come in will suffer the most, if not be replaced entirely.
Okay, time's up. Thank you so much.